Question 1. The assessment process reveals that a registered representative in California is working with a client who has expressed a strong desire to invest a significant portion of their retirement savings into a highly speculative, illiquid private placement offering. The client states they have heard about substantial potential returns and are eager to participate immediately. What is the most appropriate course of action for the registered representative? Option A. Immediately execute the client's requested investment in the private placement to fulfill their stated desire and maintain a positive client relationship. Option B. Proceed with the investment in the private placement but emphasize only the potential for high returns, while minimizing the associated risks and illiquidity. Option C. Conduct a thorough suitability assessment, considering the client's overall financial situation, investment objectives, risk tolerance, and time horizon, and explain to the client why the private placement may not be suitable, offering alternative, more appropriate investment strategies if necessary. Option D. Advise the client that the investment is too risky and refuse to discuss it further, suggesting they seek advice elsewhere. The correct answer is C. Conduct a thorough suitability assessment, considering the client's overall financial situation, investment objectives, risk tolerance, and time horizon, and explain to the client why the private placement may not be suitable, offering alternative, more appropriate investment strategies if necessary. Explanation. The assessment process reveals a scenario that is professionally challenging due to the inherent conflict between a client's stated desire and the advisor's fiduciary duty to act in the client's best interest, particularly concerning the suitability of an investment. The advisor must navigate the client's immediate financial needs and potential emotional responses with a rigorous adherence to regulatory requirements designed to protect investors. Careful judgment is required to balance client relationships with compliance obligations. The best approach involves a thorough suitability assessment that prioritizes the client's overall financial situation, investment objectives, risk tolerance, and time horizon, even if it contradicts the client's initial, potentially ill-informed request. This approach is correct because under the North American Securities Administrators Association, NASAA, model rule and state securities laws, such as those in California, investment advisors and their representatives have a continuing obligation to ensure that recommendations are suitable for their clients. This obligation extends beyond simply fulfilling a client's stated wish if that wish leads to an unsuitable investment. The advisor must document the rationale for their recommendation, including why the client's initial request might not be in their best interest and what alternative suitable options exist. This aligns with the principles of fiduciary duty and the anti-fraud provisions that prohibit recommending securities that are not suitable. An incorrect approach would be to immediately execute the client's request without further inquiry. This fails to uphold the advisor's fiduciary duty and violates suitability requirements. The advisor would be prioritizing the client's potentially misguided instruction over their professional obligation to ensure the investment aligns with the client's financial well-being, exposing both the advisor and the client to undue risk. Another incorrect approach would be to dismiss the client's request outright without attempting to understand the underlying reasons for it or offering suitable alternatives. While the request may be unsuitable, complete dismissal can damage the client relationship and fail to educate the client about appropriate investment strategies. A professional advisor should aim to guide the client towards suitable options, explaining the rationale clearly. A further incorrect approach would be to proceed with the transaction while downplaying the risks to the client. This misrepresents the nature of the investment and violates the duty of fair dealing and the prohibition against misleading statements. The advisor must provide a balanced and accurate portrayal of the investment's characteristics and risks. The professional reasoning process for similar situations should involve 1. Active listening to understand the client's stated needs and underlying motivations. 2. Conducting a comprehensive suitability assessment based on all relevant client information. 3. Clearly communicating the findings of the suitability assessment to the client, explaining why their initial request may not be suitable and presenting alternative suitable options with their respective risks and benefits. 4. Documenting all communications, assessments, and recommendations thoroughly. 5. Obtaining client consent for the final, suitable course of action. Question 2. Investigation of a municipal bond offering in California by a registered investment advisor representative reveals that the bond has received an A rating from a reputable rating agency. Which of the following represents the most prudent and compliant approach when considering this bond for client recommendations? Option A. Recommend the bond to all clients seeking conservative investments, as an A rating signifies a very low risk of default. Option B. Purchase the bond for any client portfolio that has a stated objective of capital preservation, without further investigation into the issuer or bond specifics. Option C. Advise clients that an A rating guarantees the bond's principal will be protected and that its yield will outperform inflation. Option D. Use the A rating as a primary indicator of the bond's suitability, but conduct further due diligence on the issuer's financial health, the bond's covenants, and the current economic environment to ensure it aligns with individual client profiles. The correct answer is D. Use the A rating as a primary indicator of the bond's suitability, but conduct further due diligence on the issuer's financial health, the bond's covenants, and the current economic environment to ensure it aligns with individual client profiles. Explanation. Scenario analysis. This scenario presents a professional challenge for a registered investment advisor representative in California due to the inherent subjectivity and potential for misinterpretation when relying on bond ratings. While ratings are a valuable tool, they are not a guarantee of performance or safety. The representative must navigate the regulatory landscape of California, which emphasizes suitability and disclosure, to ensure clients are not misled by oversimplified reliance on rating agencies' opinions. The challenge lies in balancing the utility of bond ratings with the fiduciary duty to conduct thorough due diligence and provide advice tailored to individual client circumstances. Correct approach analysis. The best professional practice involves using bond ratings as one component of a comprehensive due diligence process. This approach acknowledges that ratings are opinions of creditworthiness, not absolute assurances. It requires the representative to go beyond the rating itself and investigate the underlying financial health of the issuer, the specific terms of the bond, and the prevailing economic conditions. This aligns with California's regulatory framework, which mandates that investment advice be suitable for the client's objectives, risk tolerance, and financial situation. Relying on a rating without further investigation could lead to a violation of suitability rules if the bond, despite its rating, is not appropriate for the client. Incorrect approaches analysis. Relying solely on a bond rating to determine suitability for all clients, regardless of their individual circumstances, is a significant regulatory and ethical failure. This approach ignores the fundamental principle of suitability, which requires a personalized assessment of each client's needs. It also fails to acknowledge that ratings can change and do not account for all risks, such as interest rate risk or liquidity risk, which may be critical for certain investors. Recommending a bond solely because it has a high rating without understanding the issuer's financial stability or the specific economic sector it operates within is also problematic. This demonstrates a lack of due diligence and could expose clients to unforeseen risks. California regulations require representatives to have a reasonable basis for their recommendations, which extends beyond simply accepting a rating at face value. Assuming that a high bond rating guarantees a bond will perform well in all market conditions is a dangerous oversimplification. Market conditions, economic downturns, and issuer-specific events can all impact a bond's performance, even if it holds a strong rating at the time of recommendation. This approach neglects the dynamic nature of financial markets and the need for ongoing monitoring and risk assessment, which are implicit in the duty of care owed to clients. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes a holistic understanding of investments and client needs. This involves 1. Thoroughly understanding the investment product, including its risks, features, and the issuer's financial health, using rating agencies' reports as a starting point, not an endpoint. 2. Conducting a comprehensive assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon. 3. Matching the investment to the client's profile, ensuring suitability. 4. Providing clear and transparent disclosures about all relevant risks, including the limitations of bond ratings. 5. Continuously monitoring investments and client circumstances and making adjustments as necessary. Question 3. Comparative studies suggest that financial advisors in California often face challenges in recommending complex option strategies. A client in California expresses a desire to generate some additional income from their portfolio, but is also very risk-averse. The advisor believes a credit spread strategy might be suitable, but needs to ensure they are acting in the client's best interest and complying with California regulations. Which of the following approaches best addresses this situation? Option A. Recommend the credit spread strategy immediately because the client expressed a desire for income, assuming their risk aversion is secondary to this goal. Option B. Engage in a detailed discussion with the client about the specific risks and potential rewards of the credit spread, ensuring the client understands the maximum potential loss and how it aligns with their stated risk aversion and financial situation, and document this conversation. Option C. Implement the credit spread strategy and inform the client of the outcome at the end of the option's life. Option D. Present the credit spread as a way to lock in a certain amount of income, downplaying the potential for losses. The correct answer is B. Engage in a detailed discussion with the client about the specific risks and potential rewards of the credit spread, ensuring the client understands the maximum potential loss and how it aligns with their stated risk aversion and financial situation, and document this conversation. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a financial advisor to balance a client's desire for potential upside with their aversion to significant risk, all within the specific regulatory environment of California. The advisor must ensure that any recommendation is not only suitable, but also compliant with California's investor protection laws, particularly concerning complex option strategies like credit spreads. Misinterpreting the client's risk tolerance or misrepresenting the nature of a credit spread could lead to regulatory violations and harm to the client. Correct approach analysis. The best professional practice involves a thorough, documented discussion with the client about the specific risks and potential rewards of a credit spread strategy, tailored to their individual financial situation and stated risk tolerance. This includes clearly explaining that while a credit spread limits potential profit to the net credit received, it also exposes the client to potential losses up to the difference between the strike prices minus the net credit if the underlying asset moves unfavorably. This approach ensures the client fully understands the strategy's mechanics, its inherent risks, and its suitability for their portfolio, aligning with the fiduciary duty and the California Corporations Code requirements for suitability and full disclosure. Incorrect approaches analysis. Recommending a credit spread solely based on the client's expressed interest in making some income, without a detailed risk assessment and explanation, fails to meet the suitability requirements mandated by California law. This approach prioritizes a potential income stream over the client's overall financial well-being and risk capacity, potentially exposing them to losses they are unwilling or unable to bear. Suggesting a credit spread as a guaranteed income strategy is a misrepresentation. Credit spreads, while generating income upfront, carry inherent risks of loss. This mischaracterization violates ethical standards and potentially the anti-fraud provisions of the California Corporations Code, as it creates a false impression of the investment's safety. Implementing a credit spread without confirming the client's understanding of the maximum potential loss and the conditions under which that loss could occur is a failure of due diligence. This oversight neglects the client's right to informed consent and violates the principle of providing advice that is in the client's best interest, as required by California regulations. Professional reasoning. Financial professionals in California must adopt a client-centric approach. This involves active listening to understand the client's goals, a comprehensive assessment of their financial situation and risk tolerance, and clear, transparent communication about the nature, risks, and potential rewards of any recommended investment strategy. Documentation of these discussions is crucial for demonstrating compliance and protecting both the client and the advisor. When considering complex strategies like credit spreads, the advisor's responsibility is to educate the client thoroughly, ensuring they can make an informed decision that aligns with their overall financial plan. Question 4. The investigation demonstrates that a financial advisor in California is discussing investment principles with a client. The client expresses confusion about why a dollar received today is considered more valuable than a dollar received a year from now. Which of the following explanations best addresses the client's concern in a manner consistent with California's regulatory framework for investor protection and ethical advisory practices? Option A. Emphasize that the primary reason is simply that receiving money sooner is always preferable, regardless of any other economic factors. Option B. Explain that money available today can be invested to earn a return, meaning it has the potential to grow over time, and also that inflation can erode the purchasing power of money received in the future. Option C. State that this is a fundamental economic principle that is generally accepted and doesn't require further detailed explanation for most investors. Option D. Provide the client with the formula for calculating the present value of a future sum and walk them through a sample calculation. The correct answer is B. Explain that money available today can be invested to earn a return, meaning it has the potential to grow over time, and also that inflation can erode the purchasing power of money received in the future. Explanation. The investigation demonstrates a scenario where a financial advisor in California is tasked with explaining investment concepts to a client. The challenge lies in translating complex financial principles, such as the time value of money, into understandable terms that empower the client to make informed decisions, while adhering to California's specific regulatory requirements for investor protection and disclosure. This requires not only a grasp of the underlying theory, but also the ability to communicate it effectively and ethically. The best approach involves clearly articulating that money available today is worth more than the same amount in the future, due to its potential earning capacity. This explanation should be framed in terms of opportunity cost and inflation, illustrating how a dollar today can be invested to grow, while a dollar received in the future has lost purchasing power due to inflation and missed investment opportunities. This aligns with California Corporations Code Section 25210A, which mandates that investment advisors act in the best interest of their clients and provide advice that is suitable and not misleading. Emphasizing the practical implications for the client's financial goals, such as retirement planning or saving for a down payment, makes the concept relevant and actionable, fulfilling the advisor's fiduciary duty. An incorrect approach would be to focus solely on the mathematical formulas and calculations associated with present value and future value, without explaining the underlying economic principles. This fails to meet the client's need for conceptual understanding and could be seen as a failure to provide adequate disclosure under California regulations, potentially leading to misinformed decisions. Another incorrect approach would be to dismiss the concept as too complex for the client to grasp, thereby withholding crucial information. This not only violates the duty to educate and inform, but also contravenes the spirit of California's investor protection laws, which aim to ensure all investors have access to the information necessary to make sound financial choices. A further incorrect approach would be to present the concept in a way that oversimplifies it to the point of being misleading, perhaps by focusing only on potential gains without acknowledging risks or the impact of inflation. This misrepresentation would violate ethical standards and potentially California's anti-fraud provisions. Professionals should employ a decision-making framework that prioritizes client understanding and ethical conduct. This involves first identifying the client's knowledge level and financial goals. Then, the advisor should select communication methods that are clear, concise, and relevant to the client's situation, always ensuring that the explanation is accurate and complete, and complies with all applicable California regulations. The focus should always be on empowering the client through knowledge, not just presenting data. Question 5. Assessment of a California registered investment advisor's communication regarding a mutual fund's historical performance to a prospective client. The advisor has calculated the mean, median, and highest return for the fund over the past 5 years. Which of the following approaches best demonstrates compliance with California's regulatory framework for fair dealing and accurate representation of investment data? Option A. Presenting the median return without explaining its meaning or context. Option B. Presenting the median return and explaining that it represents the middle value of all observed returns, indicating a typical performance level. Option C. Presenting only the average mean return for the 5-year period. Option D. Presenting the highest return achieved by the fund during the 5-year period. The correct answer is B. Presenting the median return and explaining that it represents the middle value of all observed returns, indicating a typical performance level. Explanation. Scenario analysis. This scenario presents a professional challenge for a financial advisor in California regarding the communication of statistical data to clients. The core difficulty lies in ensuring that descriptive statistics, such as the median, are presented in a manner that is both accurate and easily understood by a diverse client base, some of whom may have limited financial literacy. Misrepresenting or oversimplifying statistical measures can lead to client misunderstandings, poor investment decisions, and potential regulatory violations. The advisor must balance the need for technical accuracy with the ethical obligation to provide clear, concise, and actionable information. Correct approach analysis. The best professional practice involves presenting the median return for the mutual fund, clearly defining what the median represents, the middle value in a sorted list of returns, and explaining its significance in understanding the fund's typical performance over the specified period. This approach is correct because it adheres to the California Corporations Code, specifically the sections pertaining to fraudulent and deceptive practices in securities sales. By providing the median and explaining its meaning, the advisor is offering a statistically sound measure of central tendency that is less susceptible to extreme outliers than the mean. This promotes transparency and informed decision-making, fulfilling the advisor's fiduciary duty to act in the client's best interest and avoiding any misleading implications. Incorrect approaches analysis. Presenting only the average mean return without further context is professionally unacceptable. While the mean is a common statistical measure, it can be significantly skewed by exceptionally high or low returns within the period, thus not accurately reflecting the fund's typical performance. This could be considered misleading under California regulations, as it might create an overly optimistic or pessimistic impression of the fund's historical results. Another unacceptable approach is to present the highest return achieved by the fund during the period. This is a cherry-picked statistic that is highly misleading and does not represent the fund's general performance. California's regulatory framework strongly prohibits the use of selective data that creates a false impression of profitability or risk. Finally, providing the median return without any explanation of what it signifies is also professionally deficient. While the median itself is a valid statistic, its meaning may not be intuitive to all clients. Failing to explain its context leaves the client vulnerable to misinterpretation, potentially violating the spirit of clear and fair dealing, mandated by California securities laws. Professional reasoning. Professionals should approach the communication of statistical data by first identifying the most appropriate measure for the context, considering the potential audience's understanding. They should then clearly define and explain the chosen statistic, highlighting its strengths and limitations. This involves anticipating potential client confusion and proactively addressing it. The decision-making process should prioritize transparency, accuracy, and the client's ability to make informed decisions, always in compliance with the specific regulations of California. Question 6. The efficiency study reveals that a registered investment advisor in California is considering recommending American Depositary Receipts, ADR, to a client seeking international diversification. Which of the following actions best ensures compliance with U.S. securities regulations and suitability standards? Option A. Recommending ADRs based on their potential for high dividend yields, assuming they are generally safe investments for diversification. Option B. Proceeding with the recommendation if the ADRs are listed on a major foreign stock exchange, without further inquiry into their U.S. regulatory status. Option C. Suggesting ADRs that are not sponsored by the issuing company, as they often trade at a discount and offer greater potential upside. Option D. Verifying that the ADRs are registered with the SEC or otherwise compliant with U.S. securities laws, and confirming the recommendation aligns with the client's documented investment objectives, risk tolerance, and financial situation. The correct answer is D. Verifying that the ADRs are registered with the SEC or otherwise compliant with U.S. securities laws, and confirming the recommendation aligns with the client's documented investment objectives, risk tolerance, and financial situation. Explanation. The efficiency study reveals a potential opportunity to enhance investment strategies for clients by exploring the use of American Depositary Receipts, ADR. This scenario is professionally challenging because while ADRs offer diversification and access to foreign markets, their regulatory treatment and associated risks require careful consideration to ensure compliance with the Securities and Exchange Commission (SEC) regulations and FINRA rules applicable in the United States. A financial advisor must navigate the complexities of these instruments to provide suitable recommendations that align with client objectives and regulatory mandates. The correct approach involves thoroughly researching the specific ADRs being considered, understanding their underlying securities, the issuing custodian bank, and the associated fees and risks. This includes verifying that the ADRs are registered with the SEC or are otherwise compliant with U.S. securities laws, and that the recommendation aligns with the client's risk tolerance, investment objectives, and financial situation as documented in their profile. This aligns with the fiduciary duty and suitability requirements mandated by SEC Rule 15C1-7 and FINRA Rule 2111, which require advisors to have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for the customer. An incorrect approach would be to recommend ADRs solely based on their perceived potential for high returns, without conducting due diligence on their regulatory status in the U.S. This fails to comply with SEC registration requirements for securities offered to U.S. investors and could expose both the advisor and the client to regulatory penalties and financial losses. Another incorrect approach is to recommend ADRs without considering the client's specific financial situation and risk profile. This violates the fundamental principle of suitability, as outlined by FINRA Rule 2111, and could lead to recommendations that are inappropriate and detrimental to the client's financial well-being. A further incorrect approach is to assume that all ADRs are treated identically from a regulatory and risk perspective. This oversimplification ignores the nuances of different ADR programs, e.g., sponsored vs. unsponsored, and the varying levels of disclosure and oversight, potentially leading to misinformed recommendations. Professionals should employ a decision-making framework that prioritizes client interests and regulatory compliance. This involves a systematic process of understanding the product adder, understanding the client, and ensuring the recommendation bridges the two in a compliant and suitable manner. This includes due diligence on the ADR's registration status, the issuer, and the associated risks, coupled with a thorough assessment of the client's investment profile. Question 7. Regulatory review indicates that a financial advisor in California is discussing investment options with a client who is seeking a safe place to invest a portion of their savings. The client specifically asks about certificates of deposit, CD. Which of the following approaches best reflects regulatory compliance and professional responsibility when explaining CDs to this client? Option A. State that the only risk associated with CDs is the potential failure of the issuing bank, which is entirely covered by FDIC insurance. Option B. Explain that while CDs are generally considered very safe due to FDIC insurance, they are subject to interest rate risk if rates rise and liquidity risk due to early withdrawal penalties. Option C. Assure the client that CDs are completely risk-free because they are fully backed by the FDIC. Option D. Emphasize that CDs offer a guaranteed return for the duration of the term, without mentioning any potential risks or limitations. The correct answer is B. Explain that while CDs are generally considered very safe due to FDIC insurance, they are subject to interest rate risk if rates rise and liquidity risk due to early withdrawal penalties. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a financial advisor to accurately represent the features and risks of a certificate of deposit CD to a client, ensuring compliance with state securities regulations in California. Misrepresenting a CD as a risk-free investment, especially when it carries certain risks, can lead to regulatory violations and harm to the client. The advisor must balance the client's desire for safety with the actual characteristics of the product. Correct approach analysis. The best professional practice involves clearly explaining that while CDs are generally considered low-risk investments, they are not entirely risk-free. This approach acknowledges that CDs are FDIC insured up to the legal limits, which significantly mitigates credit risk. However, it also correctly identifies that CDs are subject to interest rate risk. If interest rates rise, the fixed rate on the CD becomes less attractive, and liquidity risk, penalties for early withdrawal. This comprehensive and accurate disclosure aligns with the principles of suitability and fair dealing mandated by California securities laws, and the Series 66 exam's focus on investor protection. Incorrect approaches analysis. Presenting a CD as a completely risk-free investment fails to acknowledge the inherent interest rate and liquidity risks, which is a direct violation of the duty to provide accurate and complete information. This misrepresentation could lead a client to make an investment decision based on false premises, potentially causing financial detriment if they need to access funds early or if prevailing interest rates increase significantly, suggesting that CDs are only subject to the risk of the issuing bank failing, and that FDIC insurance completely eliminates this risk, is also misleading. While FDIC insurance is robust, it has limits, and the advisor must ensure the client understands these limits. Furthermore, it overlooks the other risks mentioned, focusing solely on the FDIC insurance without mentioning any potential downsides or limitations of CDs, such as early withdrawal penalties or the fact that the rate is fixed for the term, omits crucial information necessary for a client to make an informed decision. This selective disclosure can be as damaging as an outright misrepresentation. Professional reasoning. Professionals should adopt a framework of complete and transparent disclosure. When discussing any investment product, including CDs, the advisor must first understand the product's characteristics thoroughly. Then, they must assess the client's financial situation, investment objectives, and risk tolerance. The advisor should then present the product, highlighting both its benefits and its risks, ensuring the client understands how it aligns with their individual needs. This process is guided by the principle of suitability, which requires that recommendations be appropriate for the client, and by the ethical obligation to act in the client's best interest, which necessitates full and honest disclosure. Question 8. Consider a scenario in California where a client expresses a strong desire for stable, predictable income from their investments and indicates a moderate aversion to significant capital fluctuations. The client is particularly concerned about rising interest rates impacting their fixed income holdings. Which of the following approaches best aligns with regulatory expectations for recommending preferred stock to this client? Option A. Recommend a high-yield corporate bond fund, focusing on the higher income potential it offers compared to preferred stocks, and explaining that diversification within the fund mitigates individual bond risk. Option B. Recommend a diversified portfolio of common stocks, emphasizing their historical growth potential as a way to outpace inflation and provide long-term capital gains. Option C. Recommend convertible preferred stock, highlighting its potential for capital appreciation if the underlying common stock performs well, and explaining that its fixed dividend offers a predictable income stream. Option D. Recommend floating rate preferred stock, explaining how its dividend adjusts with market interest rates to help mitigate the impact of rising rates on income, while also discussing its potential for capital preservation compared to common stock. The correct answer is D. Recommend floating rate preferred stock, explaining how its dividend adjusts with market interest rates to help mitigate the impact of rising rates on income, while also discussing its potential for capital preservation compared to common stock. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an investment professional to navigate the nuances of different types of preferred stock, specifically convertible and floating rate preferred stock, in the context of a client's stated investment objectives and risk tolerance. Misunderstanding the characteristics of these securities or failing to align them with the client's needs can lead to unsuitable recommendations, regulatory violations, and damage to the client relationship. The key is to prioritize the client's stated goals and risk profile over the potential allure of specific security features. Correct approach analysis. The best professional practice involves thoroughly understanding the client's investment objectives, risk tolerance, and time horizon, and then selecting securities that align with these parameters. For clients seeking stable income with a moderate risk tolerance, convertible preferred stock might be considered, but only after a detailed discussion about its dual nature, fixed income with equity upside potential and associated risks. However, if the primary objective is capital preservation and predictable income, and the client is sensitive to interest rate fluctuations, a floating rate preferred stock would be a more appropriate consideration due to its ability to adjust its dividend based on market rates, thereby mitigating interest rate risk. The professional must explain these characteristics clearly to the client. Incorrect approaches analysis. Recommending convertible preferred stock solely because it offers potential equity appreciation without a thorough assessment of the client's risk tolerance for equity-like volatility would be a failure. Convertible preferred stock carries risks associated with its underlying common stock, which may not be suitable for a client prioritizing capital preservation. Similarly, recommending floating rate preferred stock without considering if the client's objective is solely income generation, or if they also seek potential capital appreciation would be incomplete. Furthermore, recommending either security without fully disclosing its specific risks, such as the conversion risk of convertible preferred stock or the potential for dividend adjustments, even if upward, in floating rate preferred stock, constitutes a failure to provide adequate information for informed decision-making. Recommending a security based on a general market trend without tailoring it to the individual client's profile is a significant regulatory and ethical lapse. Professional reasoning. Investment professionals must adopt a client-centric approach. This involves active listening to understand the client's financial goals, risk capacity, and liquidity needs. Before recommending any security, a comprehensive suitability analysis must be performed. This includes understanding the security's characteristics, risks, and potential rewards, and then matching these to the client's profile. Transparency and full disclosure of all material risks and benefits are paramount. In the context of the Series 66 exam and its focus on the Uniform Combined State Law exam, adherence to state securities regulations, such as those in California, which emphasize suitability and disclosure, is critical. Question 9. Upon reviewing the equity holdings within a client's portfolio in California, an investment advisor is tasked with providing an updated valuation for several growth-oriented technology stocks. The client has expressed concerns about the recent market volatility and wants to understand the underlying value of these investments beyond just their current trading prices. Which of the following approaches best reflects a compliant and professionally responsible method for valuing these equity securities? Option A. Solely relying on the most recent closing price of each stock as its definitive valuation, assuming market efficiency dictates this price accurately reflects all available information. Option B. Employing a combination of discounted cash flow (DCF) analysis to estimate intrinsic value and comparable company analysis (CCA) to gauge market perception, while clearly disclosing all assumptions and potential uncertainties to the client. Option C. Utilizing a single, highly speculative valuation metric based on projected user growth for the next decade, without considering current financial performance or established industry comparables. Option D. Applying a valuation method that the advisor finds most straightforward to calculate, regardless of its suitability for the specific technology stocks or the client's investment profile. The correct answer is B. Employing a combination of discounted cash flow (DCF) analysis to estimate intrinsic value and comparable company analysis (CCA) to gauge market perception, while clearly disclosing all assumptions and potential uncertainties to the client. Explanation. This scenario presents a professional challenge because a financial advisor must balance client needs with regulatory obligations when valuing equity securities for a client's portfolio. The advisor must ensure that the valuation methods used are appropriate, transparent, and comply with the regulations governing investment advice in California. The core of the challenge lies in selecting a valuation approach that is both sound from an investment perspective and legally defensible. The best approach involves utilizing a combination of established valuation methodologies that consider both intrinsic value and market sentiment, while also acknowledging the limitations of each. This includes employing discounted cash flow (DCF) analysis to estimate intrinsic value based on future earnings potential, and considering comparable company analysis (CCA) to gauge market perception relative to peers. Crucially, this approach necessitates a clear disclosure to the client about the assumptions made, the inherent uncertainties in any valuation, and the potential impact of market volatility. This aligns with the California Corporations Code, which mandates that investment advisors act in the best interest of their clients and provide full and fair disclosure of all material facts. The emphasis on transparency and a multifaceted approach ensures that the client receives advice grounded in sound financial principles and regulatory compliance. An incorrect approach would be to solely rely on the most recent closing price of a stock as its valuation. This fails to account for the underlying financial health of the company, its future prospects, or the broader economic environment. Such a simplistic method ignores the fundamental principles of equity valuation and could lead to misinformed investment decisions, violating the duty of care owed to the client under California law. Another unacceptable approach is to exclusively use a single, highly speculative valuation metric without considering its limitations or corroborating it with other methods. For instance, relying solely on a story stock valuation based on future unproven technologies without any grounding in current financial performance or market comparables would be irresponsible. This overlooks the need for a balanced and objective assessment, potentially exposing the client to undue risk and contravening the requirement for prudent investment advice. Furthermore, an approach that prioritizes a valuation method favored by the advisor for its simplicity, even if it is not the most appropriate for the specific security or client's objectives, is also flawed. This demonstrates a lack of diligence and a failure to tailor advice to the client's unique circumstances, which is a cornerstone of ethical and regulatory compliance in California. Professionals should approach valuation by first understanding the client's investment objectives and risk tolerance. Then, they should select valuation methodologies that are appropriate for the specific equity security being analyzed, considering its industry, stage of development, and available financial data. A critical step is to triangulate findings from multiple valuation methods to arrive at a more robust estimate. Finally, and most importantly, all assumptions, methodologies, and potential risks must be clearly communicated to the client, ensuring informed decision-making and adherence to regulatory disclosure requirements. Question 10. When evaluating a client's investment portfolio held in California, which includes 500 shares of a U.S. domestic company trading at $75 per share, 1,000 shares of a foreign company whose stock trades on its local exchange at €150 per share, with a current exchange rate of €1 equals $1.10 USD, and 200 American depository receipts ADR for another foreign company trading at $60 USD per ADR, what is the total U.S. dollar value of the client's common stock holdings? Option A, $99,000. Option B, $106,500. Option C, $100,500. Option D, $93,000. The correct answer is C, $100,500. Explanation: scenario analysis. This scenario presents a common challenge for financial professionals advising clients on investment portfolios. The challenge lies in accurately valuing and comparing different types of common stock, specifically domestic, foreign, and American depository receipts ADR, while adhering to the regulatory requirements of California. A miscalculation or misinterpretation of these values can lead to incorrect investment recommendations, potentially harming the client's financial interests and violating state securities laws. Professionals must possess a strong understanding of how to account for currency fluctuations, foreign market conventions, and the specific nature of ADRs to provide sound advice. Correct approach analysis. The best professional practice involves calculating the total market value of each stock holding in U.S. dollars, using the current exchange rate for foreign stocks and the direct U.S. dollar price for domestic and ADRs. This approach ensures a consistent and accurate comparison of the client's overall equity exposure across different markets. For foreign stocks, the calculation would be market value, foreign equals shares held * price per share, local currency, * current exchange rate, local currency to USD. For domestic and ADRs, the calculation is straightforward. Market value, domestic/ADR, equals shares held * price per share, USD. This method directly addresses the need to present a unified view of the portfolio's value in a single currency, which is essential for informed decision-making and compliance with California's investor protection regulations, such as those found in the California Corporations Code, which mandate fair dealing and accurate representation of investment value. Incorrect approaches analysis. One incorrect approach would be to simply sum the market values of the stocks in their local currencies without converting them to U.S. dollars. This fails to provide a true picture of the portfolio's value in the client's reporting currency and ignores the impact of currency exchange rate fluctuations, which is a critical factor in international investing and a potential pitfall under California's securities laws requiring full and fair disclosure. Another incorrect approach would be to use historical exchange rates instead of current ones. This would lead to an inaccurate valuation of the foreign holdings, as the current market value is based on today's exchange rate, not past ones, and misrepresents the investment's current worth, violating the principle of providing accurate and up-to-date information to clients as required by California regulations. A third incorrect approach might be to exclude foreign stocks, or ADRs, from the total portfolio valuation altogether, arguing they are too complex to value accurately. This is a failure to provide a comprehensive assessment of the client's assets and can lead to suboptimal investment decisions, contravening the fiduciary duty and the California Corporation Code's emphasis on complete and accurate client reporting. Professional reasoning. Professionals should always prioritize a holistic and accurate valuation of a client's portfolio. This involves understanding the nuances of different investment types, including international securities. The decision-making process should begin with identifying all assets, determining their current market value in a consistent currency, usually the client's reporting currency, and then assessing the overall portfolio performance and risk. When dealing with international investments, it is imperative to incorporate current exchange rates and understand the specific mechanisms of instruments like ADRs. This systematic approach ensures compliance with regulatory requirements, upholds ethical standards, and ultimately serves the client's best financial interests. Question 11. The analysis reveals that a client in California requires immediate access to a substantial portion of their funds for an unexpected emergency within the next month. The client explicitly states that preserving the principal amount is their absolute top priority, and any potential for loss, however small, is unacceptable. Which of the following approaches best aligns with the client's stated needs and California's regulatory expectations for investment advice? Option A. Proposing a variable annuity with a cash withdrawal rider, highlighting its potential for growth and tax deferral. Option B. Recommending a high-yield savings account at an FDIC-insured institution and a short-term U.S. Treasury bill maturing within the client's timeframe. Option C. Suggesting a certificate of deposit with a maturity date slightly beyond the client's immediate need, emphasizing its slightly higher interest rate. Option D. Advising the client to invest in a money market fund that has historically provided strong returns, but holds a diversified portfolio of corporate debt. The correct answer is B. Recommending a high-yield savings account at an FDIC-insured institution and a short-term U.S. Treasury bill maturing within the client's timeframe. Explanation. The analysis reveals a scenario where a financial advisor in California must guide a client regarding the most suitable cash and cash-equivalent options for a short-term, highly liquid need. The professional challenge lies in balancing the client's immediate access requirements with the inherent risks and potential returns of various cash-like instruments, all while adhering to California's specific regulatory environment for investment advice. Careful judgment is required to ensure the recommendations align with both the client's stated objectives and regulatory mandates. The best professional practice involves prioritizing the client's stated need for immediate liquidity and safety of principal, above all else. This means recommending instruments that are highly liquid, insured by government entities where applicable, and have minimal price volatility. Such an approach directly aligns with the fiduciary duty often implied or explicitly stated in California's regulatory framework for investment advisors, which mandates acting in the client's best interest. This includes understanding the client's risk tolerance and time horizon, and selecting products that are appropriate for those parameters. Recommending instruments that, while offering potentially higher yields, introduce significant principal risk or lock up the client's funds for an extended period would be a regulatory and ethical failure. For instance, suggesting a long-term certificate of deposit without clearly explaining the early withdrawal penalties and the impact on liquidity would violate the principle of suitability. Similarly, recommending a money market fund that holds a significant portion of its assets in longer duration or lower quality debt instruments, without fully disclosing the associated risks of potential NAV fluctuations, would also be inappropriate for a client prioritizing absolute safety and immediate access. The professional reasoning framework for such situations should involve a thorough client discovery process to ascertain their precise liquidity needs, time horizon, and risk tolerance. This should be followed by an objective evaluation of available cash and cash-equivalent instruments, considering their respective risk profiles, liquidity features, and regulatory protection. The advisor must then present these options to the client, clearly articulating the trade-offs between safety, liquidity, and yield, and making a recommendation that demonstrably prioritizes the client's stated objectives and regulatory compliance within California. Question 12. The efficiency study reveals a need to enhance client understanding of fund safety. A financial advisor in California is meeting with a new client who has expressed general concern about the security of their savings. The advisor is reviewing the client's existing accounts, which include both a savings account at an insured bank and a portfolio of mutual funds. Which of the following approaches best addresses the client's concern regarding the safety of their funds? Option A. Proactively explain the specific protections offered by the Federal Deposit Insurance Corporation, FDIC, for the savings account, clearly differentiating it from the investment risks associated with the mutual funds. Option B. Focus solely on the potential growth and diversification benefits of the mutual fund portfolio, without mentioning deposit insurance for the savings account. Option C. Wait for the client to specifically ask about deposit insurance before providing any details on the topic. Option D. Assure the client that all their funds are safe, because they are being managed by a reputable financial institution. The correct answer is A. Proactively explain the specific protections offered by the Federal Deposit Insurance Corporation, FDIC, for the savings account, clearly differentiating it from the investment risks associated with the mutual funds. Explanation. The efficiency study reveals a need to reassess how financial advisors in California communicate the safety of client funds. This scenario is professionally challenging because advisors must balance promoting investment opportunities with ensuring clients understand the protections available for their deposits, especially in a complex financial landscape. Misunderstandings about deposit insurance can lead to undue client anxiety, or, conversely, a false sense of security regarding non-insured investments. Careful judgment is required to provide accurate and contextually relevant information. The best professional approach involves proactively educating clients about the specific protections offered by the Federal Deposit Insurance Corporation, FDIC, for eligible deposit accounts held at insured institutions in California. This includes clearly distinguishing between insured deposits and other investment products, such as mutual funds or annuities, which are not FDIC insured and carry investment risk. This approach is correct because it directly addresses the client's need for clarity regarding the safety of their funds, aligns with the ethical duty of full disclosure, and complies with regulatory expectations that advisors provide accurate information about the nature and risks of financial products and services. It ensures clients can make informed decisions based on a clear understanding of deposit insurance limits and coverage. An incorrect approach involves broadly stating that all client funds are safe, without specifying the nature of the protection or its limitations. This is professionally unacceptable because it is misleading. While some funds might be in insured deposit accounts, others could be in non-insured investment vehicles. This broad statement fails to provide the necessary context and can create a false impression of universal safety, violating the duty of care and potentially leading to misinterpretations of risk. Another incorrect approach is to only discuss investment risks and potential returns, while omitting any mention of deposit insurance for any portion of a client's holdings that might be in insured accounts. This is professionally unacceptable, as it fails to provide a complete picture of the client's financial situation and the protections available. It neglects a crucial aspect of financial security that clients may be concerned about, particularly when discussing the safety of their money. A further incorrect approach is to assume clients understand the nuances of deposit insurance and only provide information when directly asked about it. This is professionally unacceptable because it represents a failure to proactively educate and inform. The regulatory framework and ethical standards expect financial professionals to anticipate client needs and provide relevant information to ensure informed decision-making, rather than waiting for specific inquiries, especially when discussing the fundamental safety of their assets. Professionals should adopt a decision-making framework that prioritizes transparency and client understanding. This involves anticipating potential client concerns, such as the safety of their money, and proactively providing clear, accurate, and context-specific information. When discussing financial products and services, professionals must differentiate between insured and non-insured instruments, clearly outlining the protections and risks associated with each. This proactive and comprehensive communication strategy ensures clients are empowered to make informed decisions aligned with their risk tolerance and financial goals. Question 13. Implementation of a discussion regarding a company's debt-to-equity ratio and its correlation with its stock price in California. A financial advisor is explaining the potential implications to a client. Which of the following approaches best facilitates informed decision-making for the client? Option A. State that a high debt-to-equity ratio is inherently negative, and that a positive correlation with the stock price signals an impending market downturn for the company. Option B. Present the debt-to-equity ratio and its correlation coefficient as purely statistical data points with no direct bearing on the client's investment strategy. Option C. Focus exclusively on the statistical significance of the correlation between the debt-to-equity ratio and the stock price, without defining the ratio itself. Option D. Explain the debt-to-equity ratio as a measure of financial leverage and risk, and then discuss how a positive correlation with the stock price might suggest investor confidence in the company's debt management. The correct answer is D. Explain the debt-to-equity ratio as a measure of financial leverage and risk, and then discuss how a positive correlation with the stock price might suggest investor confidence in the company's debt management. Explanation. Scenario analysis. This scenario presents a professional challenge for a financial advisor in California because it requires them to interpret and apply complex financial concepts, ratios, and correlation in a way that directly impacts a client's investment decisions and understanding. The advisor must balance the need to communicate technical information effectively with their fiduciary duty to act in the client's best interest, avoiding misrepresentation or oversimplification that could lead to poor outcomes. The challenge lies in translating abstract financial metrics into actionable insights relevant to the client's specific goals and risk tolerance, all while adhering to California's regulatory standards for investor protection. Correct approach analysis. The best approach involves the financial advisor first explaining the fundamental concept of the debt-to-equity ratio as a measure of financial leverage and risk, and then discussing how a positive correlation between this ratio and the company's stock price might indicate investor confidence in the company's ability to manage its debt. This approach is correct because it prioritizes client education and understanding. It breaks down a complex financial metric into its core meaning and then connects it to a potential market perception, allowing the client to grasp the implications without being overwhelmed by jargon. This aligns with California's regulatory emphasis on clear and accurate disclosure, ensuring clients can make informed decisions. The advisor is providing context and interpretation, not just raw data, which is crucial for fulfilling their duty of care. Incorrect approaches analysis. One incorrect approach involves the advisor simply stating that a high debt-to-equity ratio is always bad, and that a positive correlation with the stock price is a sign of imminent collapse. This is incorrect because it oversimplifies a nuanced financial relationship and presents a biased, alarmist view. Financial leverage can be a strategic tool, and a rising stock price with increasing debt might reflect strong growth prospects or successful debt utilization, not necessarily impending doom. This approach fails to provide a balanced perspective and could mislead the client into making rash decisions based on incomplete or inaccurate information, violating California's regulations against misleading statements. Another incorrect approach is for the advisor to present the debt-to-equity ratio and the correlation coefficient as purely mathematical concepts with no practical implications for the client's investment. This is incorrect because it ignores the practical application of these financial tools in investment analysis. While the advisor might be technically correct about the definitions, failing to explain their relevance to the client's portfolio or the specific company's performance renders the information useless and fails to meet the advisor's obligation to provide advice tailored to the client's needs. This lack of practical application can be seen as a failure to provide adequate guidance, which is a cornerstone of regulatory compliance in California. A further incorrect approach is for the advisor to focus solely on the statistical significance of the correlation, without explaining what the debt-to-equity ratio itself represents or how it relates to the company's operations. This is incorrect because it prioritizes a statistical finding over fundamental understanding. The client needs to know what the ratio means in terms of the company's financial health before they can appreciate the significance of its correlation with the stock price. This approach creates a disconnect between the data and its real-world meaning, potentially leading to misinterpretations and poor investment choices, which is a regulatory concern in California. Professional reasoning. Professionals should adopt a client-centric approach that prioritizes clear communication and education. When discussing financial concepts like ratios and correlations, the decision-making process should involve 1. Understanding the client's existing knowledge base and financial literacy. 2. Breaking down complex concepts into understandable terms, explaining both the metric itself and its potential implications. 3. Providing a balanced perspective, acknowledging both potential risks and opportunities associated with the data. 4. Connecting the financial information directly to the client's investment goals, risk tolerance, and the specific investment in question. 5. Ensuring all disclosures are accurate, not misleading, and comply with all applicable state and federal regulations, including those in California. Question 14. To address the challenge of a client in California expressing an urgent need for immediate access to funds, which of the following actions by a financial advisor best demonstrates adherence to regulatory requirements and professional ethics concerning equity securities? Option A. Engage in a detailed discussion with the client to understand the underlying reasons for their liquidity needs, assess their overall financial situation and risk tolerance, and explain the specific characteristics of their equity holdings, including potential liquidity constraints and market risks, before recommending any course of action. Option B. Immediately advise the client on the quickest methods to sell all their equity securities to generate the required cash, without further inquiry into their financial circumstances or the nature of the securities. Option C. Focus the discussion solely on the potential for future capital gains from the client's equity investments, emphasizing that selling now would forfeit these potential returns, and disregard the client's stated need for immediate funds. Option D. Inform the client that equity securities are long-term investments, and that their request for immediate liquidity is incompatible with the nature of these holdings, offering no further discussion or alternative solutions. The correct answer is A. Engage in a detailed discussion with the client to understand the underlying reasons for their liquidity needs, assess their overall financial situation and risk tolerance, and explain the specific characteristics of their equity holdings, including potential liquidity constraints and market risks, before recommending any course of action. Explanation. This scenario presents a professional challenge because it requires a financial advisor to balance a client's stated desire for immediate liquidity with the inherent characteristics of equity securities, particularly those that are illiquid or subject to significant market volatility. The advisor must navigate potential conflicts between short-term client needs and long-term investment suitability, all while adhering to regulatory obligations in California. Careful judgment is required to ensure the client's best interests are met and that all recommendations are suitable and compliant with California securities laws. The best approach involves a thorough assessment of the client's overall financial situation, risk tolerance, and investment objectives, beyond just their stated desire for quick access to funds. This includes understanding the specific nature of the equity securities held, their liquidity, and any associated risks. The advisor should then explain to the client, in clear and understandable terms, how the characteristics of these specific equity securities might impact their ability to access funds quickly and the potential consequences of selling them prematurely, such as realizing losses or missing out on future gains. This approach aligns with the fiduciary duty and suitability requirements under California securities regulations, which mandate that advisors act in the best interest of their clients and ensure that recommendations are suitable based on the client's financial situation, objectives, and risk tolerance. An incorrect approach would be to immediately advise the client on the fastest way to liquidate all equity holdings, without a deeper understanding of the client's complete financial picture or the specific characteristics of the securities. This fails to uphold the advisor's duty to assess suitability and could lead to a recommendation that is not in the client's best long-term interest, potentially violating California's investor protection laws. Another incorrect approach would be to dismiss the client's request outright, without exploring the underlying reasons for their need for liquidity or offering alternative solutions. This demonstrates a lack of empathy and a failure to engage in a comprehensive client needs analysis, which is crucial for providing appropriate financial advice under California regulations. Finally, an incorrect approach would be to focus solely on the potential for capital appreciation of the equity securities, downplaying the client's immediate liquidity concerns. while growth is a factor. Ignoring a stated client need for liquidity without addressing it directly or offering viable alternatives is a failure to provide holistic financial advice and could lead to unsuitable recommendations. Professionals should employ a structured decision-making process that begins with active listening to understand the client's stated needs and underlying motivations. This should be followed by a comprehensive fact-finding process to gather information about the client's financial situation, risk tolerance, and investment objectives. The advisor must then analyze the characteristics of the recommended or held securities in light of the client's profile and regulatory requirements. Finally, the advisor should present a range of suitable options, clearly explaining the risks and benefits of each, and empowering the client to make an informed decision. Question 15. Examination of the data shows that a potential investment opportunity in North Carolina exhibits strong projected future cash flows. As a financial advisor registered in North Carolina, you are conducting a discounted cash flow (DCF) analysis to assess its suitability for a client who has expressed a moderate risk tolerance. Which of the following approaches best reflects professional and regulatory obligations? Option A. Utilize a single, highly optimistic cash flow projection and a very low discount rate to maximize the calculated present value, thereby highlighting the investment's most favorable potential outcome. Option B. Present the final calculated net present value from the DCF analysis without detailing the underlying assumptions regarding future cash flows and the chosen discount rate. Option C. Focus solely on the potential for high returns indicated by the DCF analysis, assuming the client's moderate risk tolerance can accommodate any level of risk associated with achieving those returns. Option D. Develop a DCF model that incorporates multiple cash flow scenarios, e.g., base case, optimistic, pessimistic, and a range of discount rates that reflect varying economic conditions and the specific risks associated with the investment, and then present these potential outcomes to the client. The correct answer is D. Develop a DCF model that incorporates multiple cash flow scenarios, e.g., base case, optimistic, pessimistic, and a range of discount rates that reflect varying economic conditions and the specific risks associated with the investment, and then present these potential outcomes to the client. Explanation. This scenario presents a professional challenge because an investment advisor must balance the client's stated risk tolerance with the objective assessment of an investment's potential return and risk, particularly when using a discounted cash flow (DCF) analysis. The advisor's duty is to provide suitable recommendations based on a thorough understanding of the client's financial situation and the investment's characteristics, adhering to the principles of suitability and fiduciary duty under the North Carolina Securities Act. The best approach involves a comprehensive DCF analysis that considers multiple future cash flow scenarios and discount rates, reflecting various economic conditions and the investment's specific risks. This method allows for a more robust valuation by acknowledging uncertainty and providing a range of potential outcomes. This aligns with the North Carolina Securities Act's emphasis on providing advice that is in the client's best interest, which necessitates a thorough and realistic assessment of investment risks and returns. By presenting a range of outcomes, the advisor fulfills their obligation to ensure the client understands the potential upsides and downsides, enabling an informed decision. An approach that solely focuses on a single, optimistic cash flow projection and a low discount rate, ignoring potential adverse economic shifts or specific investment risks, fails to meet the standard of care. This selective use of data can create a misleadingly favorable impression of the investment, potentially violating the North Carolina Securities Act's anti-fraud provisions by omitting material facts about risk. Another unacceptable approach is to present the DCF analysis without clearly explaining the assumptions used, particularly the discount rate and cash flow projections. This lack of transparency prevents the client from understanding the basis of the valuation and the inherent uncertainties, thereby undermining the client's ability to make an informed investment decision and potentially breaching the advisor's duty to act in the client's best interest. Furthermore, an approach that prioritizes the investment's potential for high returns based on a DCF analysis without adequately considering the client's established risk tolerance and financial goals is also professionally unsound. The North Carolina Securities Act mandates that recommendations be suitable for the client, meaning the potential rewards must be weighed against the client's capacity and willingness to bear risk. Professionals should employ a decision-making process that begins with a deep understanding of the client's profile, including risk tolerance, financial goals, and time horizon. This is followed by a thorough, objective analysis of the investment, utilizing appropriate valuation methods like DCF, but critically, considering a range of scenarios and sensitivities. Transparency in assumptions and clear communication of potential outcomes, both positive and negative, are paramount. The final recommendation must demonstrably align with the client's best interests and suitability requirements, as mandated by the North Carolina Securities Act. Question 16. Research into a client's investment portfolio in Ontario reveals a strong interest in generating consistent dividend income. The client has identified a particular company whose stock price has been somewhat volatile but has a history of paying dividends. The client asks their investment advisor to use a dividend discount model to determine if the stock is currently undervalued and to project its future income-generating potential. The advisor understands that the dividend discount model relies on assumptions about future dividend growth rates and the required rate of return. Which of the following represents the most professional and compliant approach for the investment advisor? Option A. Focus solely on the company's historical dividend payments, stating that the dividend discount model confirms the stock is a good income investment based on past performance. Option B. Explain the dividend discount model's methodology, including the assumptions regarding future dividend growth and the required rate of return, and discuss how these assumptions impact the calculated intrinsic value, emphasizing that the model provides an estimate and is subject to uncertainty. Option C. Present the calculated intrinsic value from the dividend discount model as a definitive measure of the stock's undervaluation and its guaranteed future income stream, without elaborating on the underlying assumptions. Option D. Recommend purchasing the stock immediately based on the dividend discount model's output, without discussing the model's assumptions or the risks associated with the company's volatile dividend history. The correct answer is B. Explain the dividend discount model's methodology, including the assumptions regarding future dividend growth and the required rate of return, and discuss how these assumptions impact the calculated intrinsic value, emphasizing that the model provides an estimate and is subject to uncertainty. Explanation. This scenario presents a professional challenge because it requires an investment advisor to balance the client's stated desire for income generation with the inherent risks and complexities of dividend discount models, particularly when applied to a company with a history of volatile dividend payments. The advisor must ensure the client fully understands the assumptions and limitations of such a valuation method, rather than simply accepting it as a definitive predictor of future returns. Careful judgment is required to avoid misrepresenting the certainty of future dividend payments and the resulting valuation. The best approach involves a thorough explanation of the dividend discount model's assumptions, including the growth rate and required rate of return, and how these assumptions directly influence the calculated intrinsic value. This approach emphasizes transparency and client education, ensuring the client understands that the model provides an estimate, not a guarantee, and that the accuracy of the estimate is highly dependent on the validity of the inputs. This aligns with the North American Securities Administrators Association, NASAA, guidelines for investment advisors, which mandate that advisors must have a reasonable basis for any investment recommendation and must not make any untrue statement of a material fact or omit to state a material fact necessary to make the statements made, in light of the circumstances under which they were made, not misleading. Specifically, the advisor must ensure the client understands the speculative nature of projecting future dividends and the potential for significant deviations from the model's output. An incorrect approach would be to present the dividend discount model's output as a definitive indicator of the stock's current undervaluation and future income potential, without adequately explaining the underlying assumptions and their sensitivity. This misleads the client by implying a level of certainty that does not exist, violating the NASAA guidelines against making misleading statements. Another incorrect approach would be to focus solely on the historical dividend payments without explaining how the dividend discount model projects future payments. While historical data is a component of estimating future growth, it does not, by itself, constitute a valuation. This failure to explain the forward-looking nature of the model and its reliance on projections is misleading. Finally, An incorrect approach would be to recommend the stock based on the dividend discount model's output without discussing the risks associated with the company's volatile dividend history. This omission of material risk information is a direct violation of the duty to provide suitable investment advice and to disclose all material facts. The professional reasoning framework for such situations involves a client-centric approach. First, understand the client's objectives and risk tolerance. Second, select appropriate analytical tools that are suitable for the client's understanding and the investment's characteristics. Third, thoroughly explain the methodology, its assumptions, limitations, and risks. And fourth, ensure the client comprehends this information before making any investment decision. Question 17. In California, a financial advisor is meeting with a client who is nearing retirement and is primarily concerned with preserving their capital while generating a modest income stream. The client expresses a desire to invest in bonds, but is unfamiliar with the nuances of bond valuation beyond the stated interest rate. Which approach would be most appropriate for the advisor to recommend a suitable fixed income investment? Option A. Recommend bonds that have a strong credit rating and a duration that aligns with the client's time horizon, while also explaining how changes in market interest rates could affect the bond's market price and considering the potential impact of inflation on future returns. Option B. Recommend bonds that mature in the shortest possible time frame, as this will minimize the client's exposure to interest rate risk. Option C. Recommend bonds with the highest current coupon rates available in the market, as this will maximize the client's immediate income. Option D. Recommend bonds based solely on their current yield to maturity, as this is the most comprehensive measure of a bond's return. The correct answer is A. Recommend bonds that have a strong credit rating and a duration that aligns with the client's time horizon, while also explaining how changes in market interest rates could affect the bond's market price and considering the potential impact of inflation on future returns. Explanation. This scenario is professionally challenging because it requires a financial advisor to navigate the complexities of fixed income valuation beyond simple yield calculations, especially when dealing with a client who has specific, non-standard investment objectives and a limited understanding of market dynamics. The advisor must balance the client's desire for capital preservation with the inherent risks and valuation sensitivities of bonds, ensuring recommendations are suitable and compliant with FINRA and SEC regulations governing investment advice in California. The best approach involves a comprehensive analysis of the bond's characteristics in relation to the client's stated goals and risk tolerance, considering factors beyond just the coupon rate and maturity date. This includes evaluating the impact of interest rate changes on the bond's market price, assessing the issuer's creditworthiness and the potential for default, and understanding how inflation might erode the purchasing power of future coupon payments and the principal. This holistic view ensures that the advice provided is tailored to the client's specific situation and aligns with the fiduciary duty to act in the client's best interest, as mandated by California securities laws and FINRA Rule 2111, suitability. Recommending a bond solely based on its current yield without considering the potential for price depreciation due to rising interest rates is a failure to adequately assess risk and is therefore unsuitable. This approach neglects a fundamental valuation factor of fixed income securities and could lead to capital loss for the client, violating the duty of care. Suggesting a bond based primarily on its high coupon rate without a thorough investigation into the issuer's financial health and the bond's specific features is also professionally unacceptable. This overlooks credit risk, a critical valuation factor, and could expose the client to significant loss if the issuer defaults, contravening regulatory requirements for due diligence and suitability. Focusing exclusively on the bond's maturity date as the sole determinant of its value for the client, without considering how market conditions or issuer credit quality might affect its price before maturity, demonstrates a superficial understanding of bond valuation. This narrow focus fails to address the dynamic nature of bond pricing and the potential for interim value fluctuations, which is a key aspect of providing sound investment advice in California. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's financial situation, investment objectives, and risk tolerance. This understanding, then, guides the selection of appropriate investment vehicles. For fixed income, this means moving beyond superficial metrics to analyze interest rate sensitivity, credit quality, inflation impact, and liquidity, ensuring that all recommendations are fully justified by the client's needs and regulatory standards. Question 18. System analysis indicates a client in California holds a significant amount of restricted stock acquired through a private placement. The client wishes to sell this stock to generate funds for a personal investment. What is the most appropriate course of action for a California licensed investment advisor representative? Option A. Suggest the client sell the stock to a friend residing outside of California, assuming this circumvents California's registration requirements. Option B. Instruct the client to sell the stock immediately through a broker-dealer registered in California, assuming the broker will handle any necessary filings. Option C. Advise the client that the restricted stock cannot be sold in California without registration or a valid exemption under the Corporate Securities Law of 1968. Option D. Recommend the client hold the stock indefinitely until a public market for the shares develops, without exploring any immediate legal sale options. The correct answer is C. Advise the client that the restricted stock cannot be sold in California without registration or a valid exemption under the Corporate Securities Law of 1968. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves navigating the complexities of restricted stock sales within the specific regulatory framework of California. A financial advisor must balance their client's desire for liquidity with their obligation to comply with state securities laws, particularly concerning unregistered securities. Failure to do so can result in severe penalties for both the client and the advisor, including fines, disgorgement of profits, and reputational damage. The advisor's judgment is critical in determining the appropriate course of action to ensure legal compliance and protect the client's interests. Correct approach analysis. The best professional practice involves advising the client that the restricted stock cannot be sold in California without registration or a valid exemption. This approach is correct because California's Corporate Securities Law of 1968, specifically, Section 25,110, generally requires that non-exempt securities be qualified registered with the California Department of Financial Protection and Innovation before they can be offered or sold in the state. Restricted stock, by its nature, is typically unregistered and subject to resale limitations. The advisor's primary duty is to ensure compliance with these state-specific regulations. Incorrect approaches analysis. Advising the client to sell the stock immediately through a broker in California without verifying registration or exemption status is a regulatory failure. This action would likely constitute an illegal offer or sale of unregistered securities in violation of California law. Suggesting the client hold the stock indefinitely until a public market develops without exploring potential exemptions or registration options is also problematic. While holding is an option, it fails to proactively assist the client in potentially liquidating their asset legally if a viable path exists. Recommending the client sell the stock to a friend outside of California without considering the implications of the offer and sale potentially being deemed to have occurred within California, or without ensuring the friend is aware of and compliant with any resale restrictions, could also lead to violations if not handled with extreme care and adherence to exemption requirements. Professional reasoning. Professionals should employ a systematic approach when dealing with restricted securities. First, identify the nature of the security and its registration status. Second, determine the applicable state securities laws, in this case, California. Third, research available exemptions from registration under those state laws. Fourth, if no exemption is readily apparent or applicable, advise the client on the necessity of registration. Fifth, always prioritize compliance with securities regulations over client expediency. Question 19. The evaluation methodology shows that a registered investment advisor representative in California has a long-standing client who is requesting a significant shift in their investment portfolio strategy. Citing recent news, they read about new regulations that became effective on June 12, 2023. The representative needs to determine the most appropriate course of action to ensure compliance with California law and ethical standards. Option A. Implement the client's requested portfolio strategy based on the client's interpretation of the new regulations, without independent verification by the representative. Option B. Immediately research the specific California regulatory changes effective June 12, 2023, and then discuss with the client how these changes might impact their requested strategy and the firm's advisory services. Option C. Proceed with the client's requested portfolio strategy, assuming that the firm's current practices are still compliant with the new regulations. Option D. Inform the client that the new regulations are too complex to analyze immediately and propose delaying any portfolio adjustments until further notice. The correct answer is B. Immediately research the specific California regulatory changes effective June 12, 2023, and then discuss with the client how these changes might impact their requested strategy and the firm's advisory services. Explanation. This scenario is professionally challenging because it requires a registered investment advisor representative in California to balance client needs with regulatory obligations, particularly concerning the effective date of new regulations. The representative must ensure compliance with the California Corporations Code, specifically the sections governing investment advisor registration and conduct, as well as the Securities and Exchange Commission, SEC, rules that may be incorporated or referenced. The urgency of the client's request, coupled with the recent implementation of new rules, creates a potential for misinterpretation or oversight. Careful judgment is required to avoid both regulatory violations and client dissatisfaction. The best approach involves proactively reviewing the specific requirements of the new California regulations that became effective on June 12, 2023, and then communicating clearly with the client about how these new rules impact their investment strategy and the firm's advisory services. This includes understanding any new disclosure obligations, suitability standards, or prohibited practices introduced by the updated framework. By prioritizing a thorough understanding of the regulatory landscape and transparent client communication, the representative ensures adherence to California law and ethical standards, safeguarding both the client's interests and the firm's compliance. This aligns with the overarching principle of acting in the client's best interest while maintaining regulatory integrity. An incorrect approach would be to proceed with the client's requested strategy without a thorough review of the new regulations, assuming existing practices are still compliant. This risks violating the updated California Corporations Code, which may impose stricter requirements on investment recommendations or client suitability. Another incorrect approach is to inform the client that the new regulations are too complex to address immediately and to delay any adjustments. This could be seen as a failure to act diligently and in the client's best interest, especially if the new regulations offer enhanced protections or require specific actions. Finally, implementing the client's strategy based solely on the client's understanding of the new rules, without independent verification and professional judgment, is also problematic. This abdicates the representative's responsibility to provide informed advice and ensure compliance with California's regulatory framework. Professionals should adopt a systematic decision-making process that begins with identifying the relevant regulatory changes, thoroughly understanding their implications, and then assessing how these changes affect client relationships and investment strategies. This should be followed by clear, proactive communication with clients, explaining any necessary adjustments and the rationale behind them, always prioritizing compliance and the client's best interests. Question 20. Cost-benefit analysis shows that a client in California is considering a corporate bond credit spread strategy. The client will buy a bond with a coupon of 5% and sell a bond with a coupon of 7%, both with a par value of $1,000 and a maturity of 5 years. The client receives a net credit of $15 for establishing this spread. If interest rates rise by 1%, the value of the 5% coupon bond will decrease by $40, and the value of the 7% coupon bond will decrease by $55. What is the maximum potential profit and the maximum potential loss for this credit spread strategy in California? Option A. Maximum potential profit of $15, maximum potential loss of $1,960. Option B. Maximum potential profit of $15, maximum potential loss of $1,945. Option C. Maximum potential profit of $15, maximum potential loss of $2,000. Option D. Maximum potential profit of $15, maximum potential loss of $1,985. The correct answer is D. Maximum potential profit of $15, maximum potential loss of $1,985. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an investment advisor to not only understand the mechanics of a credit spread strategy, but also to accurately calculate its potential profit and loss under varying interest rate scenarios, while adhering to the specific disclosure and suitability requirements of the North American Securities Administrators Association, Nassau Model Rule. The advisor must demonstrate a clear understanding of how changes in interest rates impact bond prices, and consequently, the profitability of the spread, ensuring that the recommendation is suitable for the client's financial situation and investment objectives, as mandated by state securities regulations. Correct approach analysis. The best professional practice involves calculating the maximum potential profit and maximum potential loss for the credit spread strategy under the specified interest rate changes. This approach directly addresses the core of suitability and disclosure. By quantifying the best case and worst case outcomes, the advisor provides the client with a clear understanding of the risk and reward profile of the investment. This aligns with the Nassau Model Rule's emphasis on providing clients with sufficient information to make informed decisions, preventing misrepresentation, and ensuring that the investment's potential outcomes are transparent. The calculation of the net credit received and the maximum possible loss difference between the par value of the bonds purchased and sold, minus the net credit, is crucial for this transparency. Incorrect approaches analysis. One incorrect approach is to only calculate the potential profit based on the net credit received. This fails to adequately disclose the potential downside risk to the client. The Nassau Model Rule requires a comprehensive understanding of an investment's potential outcomes, and presenting only the upside is misleading and potentially violates anti-fraud provisions by omitting material risk information. Another incorrect approach is to focus solely on the current yield of the bonds, without considering how interest rate fluctuations will impact the value of the spread. Current yield is a factor. It does not capture the dynamic risk inherent in a credit spread strategy, particularly the potential for capital loss if interest rates rise. This omission of interest rate risk analysis is a failure to provide a complete picture of the investment suitability. A further incorrect approach is to estimate the potential profit and loss without performing precise calculations. Vague estimations do not meet the standard of providing clear and accurate information. The Nassau Model Rule, and by extension state securities laws, demand a level of precision in financial projections to ensure clients are not making decisions based on speculation or incomplete data. Professional reasoning. Professionals should employ a decision-making framework that prioritizes client understanding and regulatory compliance. This involves 1. Identifying the client's investment objectives, risk tolerance, and financial situation. 2. Thoroughly understanding the investment product, including its mechanics, risks, and potential rewards. 3. Performing precise calculations to quantify potential outcomes, both positive and negative. 4. Clearly and accurately disclosing all material information to the client, ensuring they can make an informed decision. 5. Documenting the recommendation process and the client's understanding. This structured approach ensures that recommendations are suitable and that all regulatory obligations are met.